This is Paul Donovan from UBS's Global Economics Department. What was the most important thing that the Fed did yesterday? When the history of the crisis comes to be written, it might not be the decision to ease interest rates another half point. The markets expected that. Instead, it could be the decision of the Fed to extend yet more swap facilities to some key central banks. Korea, Mexico, Singapore, and Brazil were all beneficiaries. Markets have been showing every sign of irrationality with some of these markets. CDS spreads bore no resemblance of a reference to Korea's actual debt burden, for instance. By proffering dollar liquidity, the Fed has acknowledged the solvency of these economies and recognized that there is a difference between a fundamental solvency problem and a liquidity shortfall. It is, of course, notable and laudable that the Fed has not indiscriminately showered the financial largesse of its printing press on anyone. Countries where there have been fundamental problems have not had the same treatment, but instead have had to knock on the door of the IMF. Nevertheless, the decision to cut rates did happen, just as expected. The language of the statement does not suggest that the Fed thinks that this is it as far as rate cuts are concerned. And as our US team points out, the language is very different from the language we saw the last time rates were 1%. Of course, the point is in the economic cycle is also different, and as is the expected severity of future economic weakness. Accordingly, we're now forecasting another 50 basis points of easing from the Federal Reserve. For those who are looking for the Bank of Japan to ease interest rates significantly, it is worth pointing out that the BOJ drained liquidity twice overnight. The first drain left interest rates below the target 5%, and the BOJ took a second drain in order to achieve a rate of 0.52%. Of course, there is nothing in this to prevent the Bank of Japan from cutting rates on Friday. The rate today is supposed to be 0.5% after all, but it does suggest that complacency should be avoided. We believe that the Bank of Japan will not have any economic reason to reduce interest rates further and does not wish to cut. Any rate action on Friday, therefore, may be a worrying sign of political interference. Further worries over political interference come with Senator Obama, who has suggested that the Chinese manipulation of their currency may be the reason for the large scale of the current account surplus. It is not quite clear what the senator is proposing. Perhaps he is suggesting America should become a third world country to compete head-to-head with China in export markets. Nevertheless, the rise in protectionism is certainly a cause for concern. Taiwan cut interest rates by a quarter point overnight in an intermeeting move. Taiwan is, of course, closely tied into the global economic environment and, as such, subject to the weakness of global growth. The weakness of global growth has also prompted our oil team to revise their oil forecasts for 2009. They are now looking for a $60 barrel average, with the risks asymmetric. The downside risk of $50, the upside risk of $80 a barrel. This reflects the supply and demand balance, and we do believe that spare capacity in the oil industry will be exhausted by 2013, even with the weakness in current demand. In data today, we have third quarter GDP from the United States predicted to fall by 1%, which is weaker than the market consensus. Perhaps more interestingly, particularly for those looking at financial system stability, we have the commercial paper outstanding published by the Federal Reserve, and of course including the period of commercial paper purchases by the Fed, which began on Monday. We also have consumer and business confidence from the euro area. That's all for today. Have a good day.